Okay, let's jump right into this. Right now, there is a very rare market warning signal flashing bright red. And it's not just any signal. This is the exact same one that popped up right before the dot-com burst, the 2008 financial crisis, and the 2020 crash. So, in this explainer, we're going to completely decode the current philosophy of the greatest investor of all time to figure out exactly what this warning is telling us today. To really understand what's happening, we have to look closely at Berkshire Hathaway. For the past 14 consecutive quarters, Warren Buffett's firm has been on an absolute relentless selling streak. Now, a lot of people just assume Buffett is cashing out because he's skeptical of the current artificial intelligence boom, right? But here's where the timeline gets super fascinating. Berkshire actually started this massive wave of selling way back in the fourth quarter of 2022. That was before ChatGPT was everywhere, and well before AI stocks really took off. And yet, even as the AI revolution started dominating headlines and minting brand new millionaires left and right, Berkshire just kept on selling. It honestly led to a lot of veteran investors joking that the Oracle of Omaha had finally gotten too old, or that he was just completely missing out on the AI revolution. But is he? The sheer scale of this selling is almost hard to wrap your head around. Berkshire Hathaway is sitting on nearly $400 billion in cash right now. To put that into perspective, Buffett could wake up tomorrow and buy the entirety of McDonald's or Disney in pure cash and still have tens of billions left over. That means an incredible 58% of Berkshire's total assets are just parked in cash. Now, this isn't just a big number. It is an unprecedented defensive record for Buffett's entire 60-plus year career. Over the past few decades, his cash position has historically averaged somewhere between 20 and 30%. Even right before the dot-com bubble burst, it was only at 25%. Right before the 2008 crash, around 40%. So sitting at 58% today begs a pretty massive question. What kind of crisis is Warren Buffett sensing? Well, to answer that, we need to look at the exact mathematical metric that Buffett himself relies on. Back in a 2001 interview, he publicly stated what he considered to be the absolute best single measure of where valuations stand at any given moment. It's actually a really simple calculation. You just take the total stock market capitalization and divide it by the gross domestic product, or GDP. Today, the financial world simply calls this the Buffett indicator. It's his foundational tool for figuring out if the stock market is trading at a bargain or if things have gotten dangerously expensive. The logic behind this math is actually pretty brilliant. Macroeconomics can feel incredibly abstract, you know? So Buffett translates the entire macroeconomy into a micro-example that literally anyone can understand. He treats the entire U.S. stock market as if it were just one single giant company. In this scenario, the total stock market cap is basically the stock price of this giant company. And the GDP, which is the total economic output of the nation for a year, well, that's treated as the company's annual revenue. We all know that under normal circumstances, a company's stock price and its revenue should have a rational, realistic multiple. If that multiple gets absurdly high, it means the market is just way too expensive. It's such a beautifully grounded way to look at the world. So when we map this out historically, the danger zones become incredibly clear. Buffett has given us very specific benchmarks here. If the indicator drops to 70% or 80%, buying stocks is highly rational and you're going to see great returns. But as it approaches 200%, you are literally playing with fire. Just look at the extremes. At the 1999 dot-com peak, this indicator hit almost 150%, and just months later, the Nasdaq plummeted 78%. Right before the 2008 crisis, it broke 120%, and Buffett loaded up on cash right before the market essentially halved. When Berkshire started their current selling spree in late 2022, the indicator was at 140%. And today, fueled by all this AI hype, it has skyrocketed to an astonishing 227 to 232%. This completely shatters the 1999 record, and it explains exactly why this data point looks so terrifyingly alarming right now. So, how does the Berkshire camp view this absolutely insane 227% peak? Buffett has commented on AI and the market a few times recently, and his viewpoint is pretty singular. Valuations are just way too high. At the 2024 shareholder meeting, the 94-year-old was incredibly upfront. He explicitly said he doesn't fully understand AI and he refuses to invest in things he doesn't understand. But he made a very pointed observation. He said the U.S. market is currently acting more like a casino than he has ever seen before. He is holding cash for the simple reason that he cannot find companies at attractive valuations. And Greg Abel, Buffett's handpicked successor, was even more blunt about it. He stated that the prices of most AI-related stocks have essentially already priced in the next 5 to 10 years of growth. And they are absolutely not the only ones taking defensive action. Let me tell you a bit of a financial ghost story. Right now, we're seeing 3 legendary billionaire investors simultaneously liquidating massive amounts of assets. Obviously, we have Warren Buffett with his 14 quarters of stock sales, but then we also have Michael Burry. You know, the guy famous from The Big Short. At one point recently, he cleared out his entire U.S. stock portfolio while warning everyone about a massive national debt crisis. And then there's Li Ka-shing. He spent years aggressively buying up UK assets only to suddenly pivot and sell off 167.2 billion Hong Kong dollars worth of core UK assets in just 5 months. The reason this feels like a ghost story? The absolute last time we saw a synchronized liquidation trend among these specific macro thinkers was in 2007, right before the global financial crisis. But okay, we have to introduce a pretty major plot twist here. If the Buffett indicator is flashing at a record 227%, and all these billionaires are hoarding cash, why in the world do the NASDAQ and the S&P 500 keep hitting record highs? Why are tech and AI giants just continuing to lead massive rallies day after day? Is it possible that Warren Buffett has genuinely just fallen out of touch with the modern era? Or is the market brewing a storm bigger than anything we've ever seen? It really leads a lot of analysts today to ask a very fair, thought-provoking question. Is the Buffett indicator actually broken today? To be completely fair and objective, we have to logically unpack the counter-arguments here, because there are very strong cases showing why modern economic structures might be falsely inflating that 227% figure. First off, globalization. These massive U.S. tech giants earn huge revenues overseas. That revenue heavily boosts their market cap, which is the top half of the equation, but it isn't counted in U.S. GDP, the bottom half. Second, we have to look at intangible assets. Things like software, algorithms, and patents are incredibly valuable, but they are notoriously difficult to fully capture in traditional GDP metrics, meaning the bottom of that equation might be heavily undervalued. And finally, despite the recent rate hikes, we just spent over a decade in historically low interest rate environments. That fundamentally lowers the cost of capital and changes how we value future earnings today. So these 3 modern distortions act as a really necessary pump the brakes moment before we all go completely into panic mode. But here is a modern twist that actually completely rewards Buffett's strategy. Sitting on $400 billion in cash isn't like stuffing money under a mattress anymore. With current yields earning around a 5% risk-free return on short-term U.S. Treasuries, means that Berkshire's cash pile is a highly profitable investment all on its own. Roughly speaking, Berkshire can pull in tens of billions of dollars a year in pure interest just by sitting completely still and waiting. Think about that. That risk-free yield is actually higher than the annual operating profit of most publicly traded companies. So Buffett isn't just idly waiting around. He is being paid very, very handsomely to be patient. Now, let's reveal the final twist of this explainer. If you look closely at Berkshire's recent portfolio moves, you'll see Buffett isn't blindly abandoning tech or entirely missing the AI revolution at all. He is actively swapping stocks to find real, tangible value. Over the last several quarters, Berkshire slashed its massive stake in Apple by about 75%. That Apple sale alone accounts for nearly half of all the cash they've raised. But at the exact same time, they significantly increased their position in Google by over 200%, bumping it from a minor holding all the way to their 7th largest position. They also totally cleared out their holdings in Amazon, Visa, and MasterCard. So the crucial question is, why dump Apple and load up on Google? Well, according to Wall Street interpretations, Berkshire is essentially hunting for the next Apple of the AI era. They aren't shorting AI. They want a company that can actually generate predictable, massive cash from it right now. Look at why they loved Apple historically. Incredible user stickiness through the iOS ecosystem and highly predictable cash flow from the iPhone. Now map that exact same logic onto Google today. You have unmatched user stickiness through search, YouTube, and Android. Plus, they controlled the entire stack, from custom silicon all the way to end-user applications. And the cash flow is super tangible. Search ads are still an absolute cash cow, and their cloud division has locked in massive future revenue. So they aren't buying AI hype. They are buying the underlying infrastructure and real cash flow. And this brings us to the ultimate lesson hidden in all of this data. We've looked at the terrifying 227% indicator, the $400 billion cash pile, and the strategic tech swaps. But the absolute truth here is that nobody, not even Warren Buffett, can perfectly predict the exact top of a market. And honestly, that's not his goal anyway. Buffett's true strategy is simply having enough capital and avoiding enough massive losses to ensure he survives the market cycle. He built a massive war chest so that when panic inevitably hits, he can be the one buying incredibly cheap assets. This is exactly what he did in 2008 when he injected $5 billion into Goldman Sachs and when he bought heavily into BYD when everyone else was absolutely terrified. I want to leave you with this really profound thought from the legendary trader Jesse Livermore. He once perfectly described the extreme danger of trying to perfectly time these massive market swings. He said, "I took a short position, which was right, but I sold too early. The cost was too high. My position was right, but my timing was wrong." Look, even if the Buffett indicator is screaming that the market is in a bubble right now, being right about the bubble doesn't mean you know exactly when it will pop. Warren Buffett's $400 billion cash pile isn't a magical crystal ball prediction of tomorrow's crash. It is a monument to legendary patience and discipline. So, as you look at your own portfolio, are you building a war chest to survive the storm, or are you just trying to guess when the rain will start?